Market corrections and crashes are guaranteed. They've always happened and they always will. After 25 years analyzing the markets, I've learned that they follow patterns. In the next 15 minutes, I'll show you 3 signals that commonly show up before market correction, how to protect your portfolio, and how to leverage the opportunity during a market panic. So let's dive into this. So, what most people get wrong about market corrections is that they expect that they're not a natural part of the market cycle. What you want to think is that they are an inherent feature of the markets. They always happen. Think of the markets like a living organism with lungs. It inhales and exhales. So let's dive into some charts and have a look at how often market corrections happen. There have been 25 market corrections that have happened since the start of the decade. That's just over 4 market corrections a year. This is the way it's happened in the past, and this is the way it will continue to happen in the future. So let's break down what we have seen in the markets here since 2020. The 25 market corrections, 14 of these market corrections were greater than 5%, but less than 10% in their variety. These are marked with those orange circles. Often these involve retesting of 50-day moving averages and are often very good, quick little buying opportunities for bull continuation patterns. Now, beyond that, there were 11 of these market corrections that were greater than 10%, and 4 of them, marked by the little black arrows, were corrections greater than 20% on the downside. These were those events that actually created some real opportunity for buying on dips if you were able to properly prepare yourself for one of these market corrections. Now, just quantitatively measuring the length and magnitude of a market rally alone is not enough to be able to conclude a high. So what I want to share with all of you is 3 common signals that you can use in your playbook to help you better identify when the markets are increasingly vulnerable for a market correction. So the first thing that I want to share with you is looking under the hood and looking at the market breadth. What I have here is taking those S&P 500 stocks, all 500 of them. We're just simply measuring how many of those 500 stocks are trading above their 50-day moving average, which is a very good arbiter of trend. And so what we can see is that when a market is getting weaker and weaker internally, the breadth deteriorates while the market is not showing signs of that. There was no better example of that than in the months prior to the Liberation Day market sell-off. So here, as an example, what you can observe is that when the market started making or was pushing its new highs back in September and October, its market breadth was over 80%. The vast majority of stocks were participating on the upside. By the time the market in early December made yet again another higher high, the breadth was deteriorating down to 70%. Then, when the market in January and February went to retest those highs, the market breadth deteriorated down to the 50 to 60% range. There were less and less stocks participating, more and more of them starting to sell off. The breadth was deteriorating. This is showing that the internals of the market are starting to deteriorate, which is one of the key warning signs that you can look for before potential market correction. The second indicator I want to share with all of you is talking about market momentum. And while as a chartist you can observe divergent price action and other things visually, you can use a number of different indicators out there as a gauge for whether or not there is divergent momentum. Think of it as a way where the market is continuing to make progress on the upside, but is continuously losing energy. And you start to look for those divergences in momentum to show that a market is very tired. So in this example, I'm just going to use the histogram of a MACD indicator just as an illustration of one of the ways that you can measure momentum. So what you can observe here in this 2023 going into 2024 market rally, it started strong out of the gate with a lot of momentum. But as this market rally continued to progress higher, what you can observe is that every time it thrusted higher, the momentum on the upside can continuously becoming weaker and weaker on each push higher. Now, somebody who's just observing the price of the S&P 500 sees that it's up every single day and thinks there's nothing wrong. But once you actually start seeing divergent momentum, it is actually showing that the net buying pressure to take the market higher is actually dissipating. And that is often a characteristic that you also will see as a market is approaching a high where a market correction may get underway. The third indicator I want to show is to actually observe when a market is incredibly overbought during a market advance, and arguably as well oversold to create a buying opportunity. One of the ways that many technicians will observe that is using the relative strength index, or known as the RSI. So here, as an example, I have the this market rally, and what you can observe is that while this market was advancing higher, as it approached its peaks before a market correction, you can see the RSI got above the 70 level, where it is actually an indication that the market has become overbought and simply overstretched to the upside. Now, this sometimes will be the way a market peaks out. And so, if you see that the strength of the market is getting very strong and we're very overbought, it doesn't exactly to the day say that therefore a market top is coming. But again, using that baseball analogy, it is often a clue that you're in the late stage innings of that market advance, and the risk of a market correction are increasingly growing. What I want to do is take an opportunity to explain what signals were coming in the markets prior to the Liberation Day market drop, and then talk about hedging strategies like the one we used to protect ourselves during the Liberation Day market correction. So during this market rally on the upside, during on the S&P 500 prior to the market correction, what we saw was markets back in October and November were actually getting pretty overbought from an RSI perspective on the upside. Now, that was still 3 months before ultimately the market correction began. During this period where the market was struggling up along its highs for several months, there becomes substantial divergences in momentum. As every time that market rallied, it actually met substantial overhead resistance. At the same time, like I was showing on that breadth indicator, you had the internals deteriorating considerably. Now, none of these themselves gave you a signal saying today is the day to hedge perfectly. It was more of an indication that the market's condition was deteriorating. The market was overstretched on the upside, and inevitably, a market correction was likely to ensue. Of course, you don't know exactly the magnitude or the depth of how bad or how deep a market correction would go. In this case, we didn't know that there was going to be a 20+% market drop, but we knew the conditions were vulnerable, and therefore we decided that our portfolios needed protection in this kind of a market environment. So let's talk about what we did at Big Picture Trading. Well, our hedges started back on December 11th when the market was trading back up along the highs over here. And we were hedging out into the first and second quarters of the year. And essentially, we were hedging at this 5,800 level, or the 580 level on the SPY. Now, this was a level where we basically said, well, if this market was to decline below that level, we want an insurance policy to kick in and actually start making us money to help protect and offset any losses or drawdowns we may be occurring in our investment portfolios. Why is this important? Well, most people have a hard time selling their assets. Sometimes it's for tax purposes. You know, every you sell every single time you're up money, then you're going to be persistently paying capital gains on your positions. You may have these long-term holdings that you don't want to dispose of, and yet you see the vulnerabilities in the market. This is where portfolio hedging is beneficial. It means that you don't have to go and panic and liquidate all your holdings, but rather you simply create an insurance policy saying, like I think of it like car insurance, where if the car gets into an accident, the insurance policy kicks in and pays out for it. In the same way, we bought a hedge at the 5,800 level, looking to capture a hedge to protect the downside. So between the two hedges that we carried, we ended up closing them out on April 4th. Just looking at that chart, that is essentially closing it out during this decline leg of this market. And we were able to capture a substantial profit on this hedge that helped reduce the drawdown of our portfolios, and more importantly, gave us a huge injection of cash, because down there, we believed it was an incredibly oversold condition that was an extraordinary buying opportunity. And the key to this benefit is that many of the investors that we had with the hedges on used all of the proceeds of those hedges to buy a dollar cost average or improve their positioning, so that when the rally that happened subsequently occurred, they were able to leverage it that much more. And this is the key to hedging. Somebody who, let's say, invested in the stock market at the start of the year is today, as a buy and hold investor, up 12%. But somebody who is able to improve their position by having hedged out some of this downside risk was able to easily be up even 20 or even 30% during this market rally by having reduced the loss on the way down, but also improve the amount of positions that they had to leverage the upside on the other side of the market rally. The key takeaway I want all of you to have is that market timing is not about a specific date, getting it down perfectly, but it's about preparation, seeing the warning signs, and knowing how you're going to prepare yourself in order to protect your portfolio during these downturns. A lot of people think of it like a crystal ball where you're supposed to be able to predict what is about to happen. I think of it a lot more like a weather radar where you see pressure building and you can see that certain types of weather are on the horizon. And what we want to do is always look at this not as a perfect tool where we know exactly when something's going to happen, but rather when the market is most vulnerable for something like that to happen.